Welcome to the Common Sense Investing, or CSI Show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
That's right, plain-spoken language and hard-hitting style.
Hello, Texas. This is Guy Allard here.
This is Victor McClure. Welcome to the Common Sense Investing Show. For those of you new to the show, for the last, 20-some-odd years.
More than you want to confess to.
It makes me feel old. You know, when my oldest son is turning 32, I feel just really, really old. I think of myself as like a 29-year-old or 35, but
I understand.
Definitely not
the
old.
mind doesn't age like the body does it.
You look in the mirror every once in a while and you see a stranger. Who's this gray-haired stranger in there? My wife was I'm not a big fan of the whole beard craze. Everybody's got beards now, So I tried to grow it out here a little while ago because my wife liked it, right? It's gray. And I go, I don't want it. I look old enough for that on a gray beard.
It's funny how fads come and go. Big lapels, skinny ties, big ties, skinny belts, beard, no beard, long hair, short hair.
Now it's like the one thing I had that hasn't come back since the Magnum PI days was like the mustache, just the mustache alone. Remember?
Right, yeah.
Back then, Robert Redford had a big mustache. Everybody had a big mustache.
I had a mustache back then.
Yeah. What's his name? Smoking the Bandit guy.
Burt Reynolds.
Burt Reynolds, yep. He always had a mustache. Now you don't see too many mustaches.
He's got to be about 90 now, doesn't he?
I don't know. Is he still alive?
Yeah, he is. Yeah.
He's pretty old. But I saw that show again the other day. I haven't seen it in 30 years. It was actually pretty funny. Buford T. Justice.
Eli Elm and a bunch of people, old timers on there.
Oh, I know. I see these shows now, and now that they have, HD video, everything's high definition. When you watch one of those older shows, you're like, man. I remember that my TV was fuzzy watching it anyway.
You ever go back and watch some of the 70s shows, that sitcoms and all of that were great in their day?
Oh, yeah.
You sit down and it's just not the same.
I watch Good Times with Kid Dynamite.
Oh, yeah. Nowhere near as funny as it was when you were 17, is it?
I know.
Or 16.
I forgot all the issues, like Archie Bunker was there, brought up, racism, all kinds of stuff. I forgot that was part of the deal.
I'm trying to think of who the producers were. There was a group that did all of those,
right,
but it escapes me.
Well, Rob Reiner was it's Meathead, right?
Yep.
On there, and he was the liberal, and I think Rob Reiner's still a very big liberal.
Sally Struthers was there. Oh, yeah.
All right. Well, we're going to talk today about the bucket strategy. You can segment your money into different segments, okay? And these segments, even though they work in conjunction with each other, they're very different. And you can't commingle them as much as you might want to.
No.
Our natural tendency, if something's doing well, like stocks, put everything in there.
That's right.
But you need the buckets.
That goes back to the balancing theory, and think about the name of the show, Common Sense Investing Show. This just takes common sense, and what we like to do for our listeners, for you, as we do with our clients, is keep it simple for you. I know you must have questions in what order, but where do they go? The three buckets. We talk about the buckets of liquidity, having money for life's little hurdles. Then we talk about, you hear us talk about all the time, make sure you have enough income in retirement to take care of your bills. If you know your bills are taken care of with certainty, how much trouble, other than health trouble and some things like that, it really makes your life easy. The worry, the stress goes away. And then the third bucket is an inflation hedge. Obviously, everything is going to cost more 20 years into retirement than it does today. So you need to have your money grow a little bit so that it perhaps can augment that income. And then the next question is, what order and
right,
how should I do this?
One problem I see people doing is we are creatures of habit, human beings, right?
Absolutely.
The more comfortable with something we are, the more we do it. The more we make in something, the more we add to that bucket. But what happens is people will try to create the bucket strategy, but with one item, like let's say it's stocks. No, I've got a bucket strategy. I've got dividend stocks for the income. I've got some stocks that I know they're blue chips. They're not going anywhere. That's my safe money. That's my reserve money.
Right.
And then I've got the growth money. That's a little more risky stuff.
Or REITs, perhaps, for income.
All of those different things. The problem is the income is not guaranteed. The income is not going to give you a guaranteed check. Because I'll tell you what, when you're in retirement, the bills aren't going to stop. They're not going to stop because somebody lowered a dividend. Or somebody, you got a REIT that's part of the properties is under foreclosure and they can't pay rent, which when you get some of these REITs, if you just knock 10% occupancy off, they're losing money because the promoters have put so much extra juice in there.
Everybody's got their hands out, just like in Washington.
Don't get me wrong. But when things are like now, if I've got a REIT is a real estate investment trust, by the way.
Very good, yeah.
If I've got a real estate investment trust and you're 100% lease, you're probably doing great. Values keep going up, everything else. But it's just like everything else. Everybody overdoes it. When when real estate goes bad, they overdo it. Nobody builds anything for 10 years. In Dallas, I think they quit building apartments for like 20 years.
Remember in the 80s?
Yeah, they build them up, then they never build them again until recently. But now they're filling up, rent's gone crazy. And so you want something that's guaranteed in the income bucket.
And these buckets it's far-reaching, right? If you combine a lot of the shows that we've done, how you distribute these buckets and all of that has a lot to do with the psychology of investing that we talk about. It has a lot to do with our propensity to avoid pain, whether to gain pleasure. And what I mean by that is to gain pleasure would have an equal balance, and the income's taken care of and the liquidity's taken care of, but we don't do that. It's painful when your stock bucket has grown so big, your inflation hedge bucket. It's painful to take that money out, isn't it, and move it somewhere else.
Put it in my cash bucket that makes 1%.
That's right.
That's hard to do.
But you need to do it.
Absolutely. If everybody would rebalance their portfolios, very few people would take the big downturns of the market. You still take a downturn, don't get me wrong, because your equity piece is going to take a downturn. But if your equity piece has grown to 95% of your portfolio, that's when you take the full 50% drop.
And sorry, I just had a flash before I forget it.
Sure.
Which is a real important point as far as to make sure that whoever your advisor is or whoever's helping you isn't just a stock guy or just an insurance guy. Because if they are just a guy in that area, what are you going to get? What's your portfolio going to look like?
It's going to look just like whatever they sell.
And what happens if you've got the REITs like you talked about, but it's a form of stock, and you've got the dividends, ConocoPhillips, which went down, and that's dividends, so that's your income, but you're in stock, and then you got your stock in stock. What happens when you're in retirement and you withdraw from, what's that fancy term for cyclical?
Sequence of returns risk.
Sequence of returns risk. Write that down. We'll test you later. But you can't do it. It doesn't work. Because like when the market loses 50%, it takes 100% to get it back. It's the same thing when you're withdrawing and it loses, and now you've got a smaller corpus or a smaller principal to still take that same large withdrawal. It just really hurts you.
Well, just think if you're getting 2% dividends, right?
Right.
And they lower it down to 1.5. Well, your bills aren't going to change.
No, they don't.
So you got to sell some of those things. So from now on, you have less stocks earning 2%. Or 1.5, whatever the number is. Absolutely. And so I call it the death spiral.
And think about that real quick. It went from 2 to 1.5. Doesn't sound like much at all, right? It's 25%. If your bills are, I'll use a decent number, $10,000 a month, and that's what you've planned for. Well, now you've got $7,500. Yeah. Where's the other $2,500 coming from?
Yeah, so that's why you cannot. People do it all the time, and it's usually from their advisor or what they personally like. In other words, I'm comfortable with stocks. I've been doing stocks, blah, blah, blah. But the problem is you can't use stocks because people can stop a dividend. It doesn't kill their stock all the time. Dividends on utility companies like oil companies used to be in the double digits easily for a long time. Shell, rolled that Shell, huge, Exxon, huge dividends. They're not so good anymore. And so they can do that at any time. So unless you can negotiate with your electric company to pay less if the market's down, then you wouldn't do that. So the buckets have to be in certain areas. So let's talk about the reserve bucket first.
And I always get the question, I'm sure you do too, what's the priority of the buckets and why?
We'll go in order of priority.
All right.
The number one, believe it or not, is not your stock. It's your reserve bucket.
And it's not your income. It's your
reserve
bucket.
You have to have enough liquidity in retirement because life's things happen. I don't know. I've got 4 kids. There's always something going on. As you get older, your kids, my oldest is 32, they might need something. I got to have some money there.
Those kids are just walking Petri dishes, aren't they? I mean, someone's always sick.
Right, or I got a client right now that has to have a experimental surgery. The insurance only can pay for 80% of it, which is better than nothing, right?
Sure.
But the 20% could be $50,000 or something.
That's crazy.
And
That's
so if you didn't have a reserve account, that would be tough. And you need to so reserve accounts should be liquid and short term.
But you know what, Victor? I could take it out of my stock account, or I could take it out of my income bucket. Why would I want to have all that money getting 1%? Well, I'll give you the stock part of it, and let Victor give you the income. If the stock is like, let's say that this life's little hurdle presented itself to you in 2008, and the stock just went down 30%, whatever the value was originally. Now you're going to have to take $50,000 out of a lower number, and it's catastrophic.
Takes too long to get it back, and it'll come back, but it took 8 years last time.
You can do that, but it ruins the plan.
But if you're already making $300,000 a year at your job or whatever, you can withstand that kind of stuff. When you get close to retirement, the paycheck's gone.
You can withstand it if you're making $300,000 a year if you're not spending $270,000.
That's right. That's true.
And most people who make a lot of money have a high style of life.
And the one thing I've seen people do is they'll buy a bond fund for their reserve piece. You shouldn't buy a bond fund for your reserve piece unless it's a very short-term bond fund. Because remember, interest rates go up, bonds go down. You shouldn't be taking a lot of risk in your reserve bucket. That's your full reserves. I understand CDs, money markets aren't paying crap.
Good news is they should be going up a smidge here if the Fed raises rates.
Now, what you could do on the high side on some of those, maybe you could buy a 5-year CD, right, instead of a 1 year.
As long as you have some withdrawal capabilities.
That's right. And so what if you got is this. Remember, a CD is liquid. It just has a penalty for the 5 years. Some of them are not that bad. It's like 6 months where the interest is your penalty.
Right.
And so I'm okay to get that extra yield going a little longer on a CD and still being in my reserve bucket. Also, some of your, straight fixed annuities, they're called MYGAs or CD annuities.
Right.
They basically just pay, I got one now, 3.5% for 5 years.
And some of those will allow you to take 10% of the total balance out for emergencies. It makes it a little bit easier.
Even if they didn't and you had to pay a penalty, you can still get 95% of it anytime you want it or whatever. So that's okay. Those kind of things, the maximum you probably want to go out is 5 years. I wouldn't do, normally 5-year bonds can be okay, but not right now when interest rates about to go up.
Let's talk about this. How much should I have in there? Now, it used to be, I've heard 3 months a long time ago. It went to 6 months. Is it officially a year now?
Well, it's still, if you look at the financial planning journals, and it still says 3 to 6 months, but that can't be the same across the board. Think about it. When you're 30 years old, 3 to 6 months worth of expenses, okay, that'd be a good reserve. What about you're 70 years old?
Yep.
Should you be the same exact reserves as a 30-year-old? No.
That's right.
My golden rule is 1 year to 2 years worth of expenses in your reserve account at all times.
Now, understand there's a lot going on, right? There's a lot of peripheral stuff. If you're saving for 529s, you have kids going to college, you're buying a house because you're in your, all this stuff happens when you're in your 30s. It's not till you get to your 50s where you really crest and get to start saving. So we know. So if you have 3 months saved up, if you have 6 months saved up in your reserves, good for you. Maintain that, and that's great. If you can bump that up and get that to a year, that's just a high-class problem, but we would encourage that as you move along down the road.
Even your younger folks, 3 to 6 months is the rule, but even your youngers wanted to save a year. Think about this. Last 2 times the market crashed. Remember 2008? It was actually 2008 into 2009 a little bit, but it went 55% from the high.
Yeah, that's crazy.
And if you had anything, like I saw my neighbors bought their house for $300,000. This house is probably $1.3 million. I go, so cash is king. So even if you're younger and you say, I don't think I should have this much reserve, keeping your powder dry, having a little bit excess if a market's peaking is not too bad of an idea.
And it takes self-control and discipline to do it. In the 2000s, Victor and I had friends that were, some that did and some that were ready to quit their jobs and start trading, and their money, the diversity within the one bucket. You need to have diversity. Tech stocks, regular stocks, dividend stocks, maybe some good REITs. It all melded into high tech. And how much did the NASDAQ go down in 2000?
Oh, yeah.
It was crazy. It was crazy.
Oh, yeah. People lost a lot then. Remember, if you rebalance all the time, that doesn't happen to you. But that's your reserve bucket. Very important, most important thing, because let's say you had to take it out of a retirement account, it goes all to income that year. And if it goes to income, I got to take out 130, 140% of what I need just to pay the taxes.
Translation, if you need $60,000 to pay for an event and you take it from your qualified account, right, you have to take $100,000 out because you're getting taxed, let's say 40% because it's a large chunk on top of your other stuff. 40% on the 100 leaves you 60. So that $60,000 event just became a $100,000 event.
Right. That's another reason why it's important to have the reserve bucket.
That's right.
Life's things happen. You know, if you
no shortcuts.
If you have any daughters and how much it costs, just anything with wedding attached to it is a ripoff. Even the flowers are $40,000. Are you on dope? $40,000 for flowers? Where are they getting these flowers?
I have a new client that works for the AG's office, and he has twins. And when I was talking to him and getting all the information, he goes, "Oh no, I've got a lot of expenses. I've got twins." And I'm thinking, a couple of kids. I said, "Oh, I understand." He goes, "Oh no, you don't understand." And then he says, "Okay, I get it. It's expensive."
Oh, I just paid the bill the other day. Well, my one son's got the karate class. Well, he's got the team karate, so it's like, $600, $700 a month. I got the other one that's in the elite league basketball.
I couldn't believe you're telling me you've got him in mathnasium. I never heard that word didn't exist when we were in school.
Well, see, remember, I'm a math guy.
Right.
I love math. It's fantastic. I've always been good at it. Easy. It was always simple. Not one of my children developed that math gene. Not one of them.
There's time, no?
No. It's
time. There's time.
No.
Maybe the younger one.
It would be real difficult to develop that at their age, I think.
All right, so we have the liquidity 3 to 6, good for you. If you can bump it or gradually get it to a year, even better.
Yeah, you got to have some money market component, savings, checking accounts, stuff like that. The most you want to put in that, not all of it, just up to a 5-year kind of thing. But remember, still liquid. This is all liquid funds. You can have a penalty on part of it, like a 5-year CD versus a 1-year. That's okay, because you can still get 95% of the money if you wanted to, or 98%, whatever. So those are fine, but that's what you put in the reserve bucket.
And our clients, what we do for our clients, in case you wonder what happens behind the desk, is when we have a situation come and we know the amounts and the needs, we'll shop all of that for you. And we don't make the decisions. That's not what we want to do. We find the best alternatives for the short-term liquidity, for maybe a 5-year liquidity, and then present you with the options and let you make the best choice.
Right. All right, now let's talk about the income bucket.
I like the income bucket.
The income bucket, this is something you're going to have to live on. These are your expenses. Now, you're going to put things that aren't assets but income in your income. Like your Social Security is going to be part of your income bucket. It's not going to be an asset in there, but it's going to be part of it. Because if I've got $10,000 a month in bills and I'm getting $4,000 Social Security, I only need to make up $6,000, right?
That's right.
Any pensions, all right? Pensions, Social Security, anything like that's going to go in the income bucket. Now, there's 2 ways you can go at this, and I'll show the way we do it. Some people say, well, as long as I've got $1 million over here, as long as I make 6% a year, I can sell this stock and pay that extra $6,000 a month that I need for the income bucket.
Right.
But we've already talked about that ad nauseum, why that is very extremely dangerous. What is better is CD. CDs just don't pay anything, but they're great. They don't have interest rate risk.
Guaranteed. You know what you're going to get.
As long as you're doing your $250 per deal, they don't have default risk, right? So they're good. The problem is they don't pay much. So CDs are an option. Bonds are an option. You got to make some really safe bonds. You don't want to be buying high-yield bonds for this particular budget.
It's tough right now with interest rates rising, and I would add into the conversation that this, for your 401k, unless it's huge, more if it would provide more income than you need, then you can partition it out, and your IRAs. And why is that good for the income bucket? At 70 years old, you've got RMDs, required minimum distributions. The government makes you take withdrawals, and it increases it every year you live so that they can get their tax money. So that's a hand-in-glove fit for the income category.
That's right. And so now, there's one thing you can do. You can take, let's say you have hard expenses. Well, this is the minimum of guaranteed income you have. Because hard expenses, you cannot break them down. In other words, I owe the electric company $500. I can't give them $50. Right? You have to, so that has to be guaranteed income. I see people all the time trying to make that dividend income or real estate investment trust income. Nope. It has to be guaranteed. The only way to guarantee it, like maybe a government bond or a really high-rated corporate bond, because as long as it's AAA or something, you're pretty good there, or like an annuity. The reason why annuities are so popular the last 20 years, the most fastest-growing investment in the world, because they pay more income than the other alternatives. That's really it. If you're looking at an income planning and an income bucket, it's different. Some people use them as a growth bucket. They just want some safety. But more and more people use them as an income bucket. So it's up to you. You got $1 million, CD, you'll pay you $10,000 a year. So you can put that $10,000 a year with your Social Security and your pensions, see if it makes enough. A bond, you can probably get about 3% right now. So $30,000 a year. You can make anywhere from $50,000 to $100,000 a year on the same $1 million in an annuity bucket. You use an annuity for that one piece.
And there's the point, because in the old days, and you've probably heard the term, maybe you've set one up, you used to have CD ladders and bond ladders. And you could do that because the rates were commensurate with what you would need in retirement.
Don't work right now. You have an inverted yield curve anyway.
Exactly. But what the ladder does is you buy one that's going to mature, so you don't have to worry about selling it at a discount or premium. Right. You buy it when one's going to mature when you're 65. You've got another one that's going to mature when you're 66, 67, and so on. But right, it's inverted yield
right now, or it's a flat yield curve, which makes the long stuff not even worth it.
And the rates are terrible.
That's right.
Especially if those would be.
But you can still use those.
Yes.
Anybody tells you I hate these annuity salesmen, say no, it's the only thing in the world. No, it's not. You can use a bond. You can use. Now, let's say you've got discretionary expenses. You have $8,000 a month in real bills, right? Actual bills, hard expenses. That one has to be guaranteed money. Social Security, pensions, annuity income. Those are guaranteed incomes. Or bond income or CD income. Those can be that part. So here's where you can fudge a little bit. Let's say you've got discretionary expenses of another couple thousand a month. Well, it's okay with those discretionary if you want to use a REIT or some stock dividends. The problem is you got to use a lot of them because the S&P only has a dividend rate of like 1.8%.
That's right.
But see, people are more comfortable with it. I always see people trying to marry the two. No, I'm more comfortable with this. I've heard annuities with the devil's work, blah, blah, blah. I'm going to put it all over here. But not only does it take 5 times more money to produce the same income, but your income is not guaranteed. Your income cannot last. It can be changed, and your bills can't. So hard expenses have to be a guaranteed income stream. You can use annuities, CDs, or bonds.
And I would add to that, you've heard Victor and I talk for years about being effective and efficient, right? Well, no matter what we do in life, whether it's at work, whether it's with your children, you want to be effective and you want to be efficient. You want to get as much for the least amount of effort. Not that you don't want to work, but you want to get as much as you can for the least amount of effort. With the fixed annuities, and one of the reasons that we've used them since about 95 and really worked them well for our clients is you can get a couple birds with one stone, and we can get into that. We'll get into the income, kind of give you some examples, but they will also take care of your long-term or part of your long-term care problems, some of your nursing home costs, and they do some other peripheral things that'll help.
Well, just think about this. Let's say remember, I don't care what you use. I'm just trying to tell you, using an annuity right now pays more than everything
Biggest
else.
Bang for the buck.
Let's say I've got $1 million allocated to my income bucket. All right, I can put in a CD. You're going to get $10,000 to $20,000 a year in income. Put in a bond, you might get 30, maybe 40 if you're real lucky. If you're sticking with AAA, bonds, stuff like that.
But you need to.
Right. So, what if you got 70, 80,000 a year instead, and got another 80,000 for 5 years if you went to a nursing home? Well, it's a better use of the funds. And that's why, so I can put less money to create the same income or the same money to create more income. Plus, you get a long-term care benefit on top of that, which I'm telling you, what do they say? In this person's lifetime, it's like 90% of people will use it. Now, I might use it for 6 months.
Right.
Some might use it for 5, but 90 or 78%, something like that, will use it.
It's a big number.
You have to address that. If you're really wealthy, you can self-fund any kind of retirement thing, right?
Right.
I mean, not long-term care event. But it's nice if you can have it as a package. I'm getting double the income I could off any other income producing, and I got an extra long-term care benefit with it. And you can there's other ways to do long-term care too. You can do it. You don't have to use an annuity. A lot of people now are using life insurance policies.
But if you can do a couple things with the same dollar, you have a dollar that's going to take care of your income. You have a dollar that's going to take care of your long-term care needs, at least for a significant period. And in using life insurance, they've got some programs that use pretty much, they wrap a equity index annuity in it to show their growth. You can get tax-free income, and you got to be in the good health, and you got the weight and the height chart, which I know is hard to do. All that stuff's got to match up so that you can get. It's not good for everybody, but the people that can use life insurance. I've got an example of a client I'm working with that had about $400,000 he wanted to play with. We're taking $250,000. He's putting $50,000 a year in for 5 years, so $250 total, right? 50,000 year one, another 50 year 2, 3, 4, and 5. 250 total. He's 55. By the time he's 70, he can withdraw $40,000 a year tax-free. He immediately has a death benefit of about $730,000, of which 25% roughly is available for long-term care for 4 years in a row.
So you get, what, $700,000 over 5 years in long-term care?
About 5 or 6. Now, there's a couple caveats. The program, the best it's done is 9.8%. The average is 7.5%, and I think the worst is about 5%. Those numbers were based on the average of 7.4. So it's not 100% guaranteed. There's some flexibility. The fixed indexed annuities are 100% guaranteed and a big bang for the buck. So it just depends on where we can place you to be the most efficient.
Put that in perspective. We just said the income bucket, you can use an annuity, you can use anything else. Or now, if you used that same $250,000 in a CD,
yep,
you get $2,500 a year, right? 1%, 25.
That's scary. What a difference.
Yeah, 10% would be 25,000, right? So $2,500 a year. This was $38,000, $39,000 a year tax-free. If you put it in a bond, you're talking about $7,500 a year.
3%.
Even if you had some growth on that $250 for the 10 or 15 years, right? You're still not going to get more than $20,000 a year, taxable. This is almost $40,000 tax-free.
And keep in the basic principles of life. For every action there's an equal and opposite reaction. So it's that sort of thing. One's guaranteed, one's not. One pays part of long-term care, one doesn't. So you have to sit down. What you want is something guaranteed to take care of that income bucket regardless of what happens.
Yeah, one thing I hate is everybody, the advisors and everybody else, they say that one product can fill all your needs.
Right.
All you need is this mutual fund or this managed account and you're set for life. Well, that's not true. You need a lot of different components if you're going to be successful in this stuff. Don't get me wrong. Some people get fortunate and just the truth is you're probably not spending a whole lot. They saved quite well, and they're not spending a whole lot. So that affords you a lot of mistakes.
Absolutely.
So when you're a normal person, though, you need these kind of buckets. We'll talk about we're going to run out of time. We'll talk about the growth bucket. That's also called your inflation protecting bucket. That's going to be your stocks and bonds and things like that.
And we have some good alternatives for you.
Yeah, we'll talk about that on another show. But the income bucket, remember the reserve bucket, is the most important because life's emergencies happen. You got to have some kind of cash. I know it's not going to pay a lot, but that's not the purpose of it. The purpose of it is to protect you against anything that you might have to do, not have to sell your growth inflation bucket or, forbid selling your income bucket because that's what it is. Now, hard expenses at least, minimum. Some people want to go even more than real expenses. But hard expenses, you can fudge a little bit with your dividend-paying stocks, REITs, to cover the actual expenses. Hard expenses have to be a guaranteed number. Anybody that tells you I got advisors all the time, no, you don't need it. And I go, they're gambling with your lifestyle right now.
What he's saying is don't let anyone talk you out of your liquidity bucket for their investment.
That's right. You got to have all of these different components. And if you put it together correctly, retirement's not going to be that. You're not that scared of the stock market or anything else because, remember, the stock market's fine. There's nothing wrong with stocks.
You need to have it.
Now, you just got to put them in conjunction with these other buckets. Well, that's our show, folks. I want to thank everybody for listening to the Common Sense Investing Show today. Remember, if you have any questions, you'd like to talk about the bucket strategy or anything else, our number is 972-715-2424. Again, 972-715-2424. You can always go to our website, ilovemyretirement.com. I'm Victor McClure for Guy Allard. We always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.